Hello students, welcome to the new series of economics, that is Explore Income and Determination. By the name of series, you might have understood that in this series, we are going to discuss the chapter Determination of Income and Employment. And in this chapter, we are going to discuss all the important concepts related to income, employment and output. So, few concepts here are like aggregate demand, aggregate supply, consumption function, saving function, and we are going to see lots of schedules and graphs in this chapter, which are very important. So, let us begin with our first concept, that is aggregate demand. In short, we also call it as AD. So, basically, till now in microeconomics, you have already learned the concept of demand and supply. So, you might be knowing that whenever we study demand, we study it from the perspective of a consumer. And same way, when we study supply, we study it from the perspective of a supplier, who is also called as a producer. Right? So, this concept we have already seen in our microeconomics. But in 12th standard, we study macroeconomics. And in macroeconomics, we do not deal with individual demand or individual supply. Here we are going to deal with aggregate demand and aggregate supply. Now, what do we mean by aggregate? What is aggregate? So, aggregate is nothing but sum of, or you can say aggregate is sum of all the production. Okay, so this is nothing but aggregate. Now, aggregate of what or sum of what? So, sum of the demand made by different sectors of the economy. Now, in circular flow of income, we have already studied what are the different sectors of the economy. So, let us just recall these sectors. So, sectors of an economy, there are 4 sectors in any economy. First, household. Household is nothing but the consumers who are going to consume the goods and services. Second sector is firms, private firms who are going to invest on capital goods. Third was government. Government is also a very important sector of the economy. And last one was foreign sector, which is also called as rest of the world, which is basically going to deal with importing and exporting of goods and services. Now, every sector of the economy is going to demand something, right? Exactly. So, in every sector demand for goods and services, we call it as aggregate demand. When we sum off all the 4 sectors of an economy, the demand of all the 4 sectors of an economy, we call it as aggregate demand. This is what aggregate demand is. Now, we know that whenever a person or whenever any sector of the economy will demand for the goods, they will but obvious have to do an expense. If for say suppose I demand for food, I will go and buy food. So, that will be basically my expense, it will be my expenditure. So, same way here also, when any sector of the economy, or for that matter when all the sectors of an economy demand for goods and services, they will have to do certain expenditure, and that is called as nothing but aggregate expenditure. The expenses done by all the sectors of the economy is called as aggregate expenditure. For example, I as a human being is demanding for a chocolate. Okay, I have a demand, I have made a demand for chocolate. Now, when I go to the market, I will purchase that chocolate. So, say suppose that chocolate was for 10 rupees. So, this 10 rupees is nothing but my expense. So, aggregate demand is nothing but your aggregate expenditure. So, that is why we can say AD is always equals to AE. That is, aggregate demand is nothing but aggregate expenditure. Both the terms you can use it with each other. These both the terms are alternatives of each other. So, aggregate demand is equals to aggregate expenditure. I hope the basic of aggregate demand is clear to all of you. So, when different sectors of an economy are going to demand for the goods and services, and when we sum up the demand of these sectors of an economy, we call it as aggregate demand. In macroeconomics, we are not going to talk about individual demand, we are going to talk about aggregate demand. That means the demand done by the all sectors of the country or the economy. So now let us see the meaning of AD, what exactly AD means. So AD is nothing but the value of final goods and services. Now here again, one thing which you have to notice is the value of final goods and services. It will not be the value of intermediate goods. Now we know what are intermediate goods, we know what are final goods. So when we talk about AD, we will always take the value of final goods and services, which all the sectors of an economy, all the sectors means the four sectors which we saw right now: household, firm, government and foreign sectors. So all the sectors of the economy are planning to buy at a given level of income during a period of one accounting year. Okay, so that means aggregate demand is nothing but value of final goods and services which all the sectors of an economy are planning to buy. Very important, planning to buy. These sectors of economy are just planning to buy those goods and services. They have not actually bought it. For example, I am planning to buy a TV. Okay, I am planning to buy a television. That television is going to cost me for 10,000 rupees. Now this I have just planned in my mind. I have not actually done this expense. I have not actually done this transaction. This is just my plan to buy a television, to buy a TV. So here also when we study the concept of AD, we will take only and only the planned expenditures of all the sectors of an economy with the given level of income depending upon the income of the consumer during a period of accounting year. That means AD is always measured once in a year, once in a financial year. It means AD and AE mean the same. Yes, that is what we saw right now. Aggregate demand is always equals to aggregate expenditure. That means you can use the terms interchangeably. Yes, definitely you can. So, aggregate expenditure refers to planned expenditure. So, aggregate expenditure is nothing but your planned expenditure. It is not the actual expenditure. It is just the planned expenditure which the four sectors of the economy have planned. They have not actually done that transaction. They are just planning to do that kind of expenditure. Then, what are the important components of AD? Very important. The four components of AD. So, it goes like this: C plus I plus G plus X minus M. This is nothing but your components of AD. Very important part from the chapter, the components of aggregate demand. So basically, you can represent it symbolically like C plus I plus G plus X minus M, wherein C stands for nothing but consumption expenditure or private household. I stands for investment which the private firm makes. G stands for government and X minus M is nothing but your foreign sector or rest of the world. So let us start with the first one, that is your first private household or consumption expenditure, which includes we as a consumer who are going to consume the different type of goods and services present in the economy. That is nothing but the first component and it is represented as the capital C. Consumption expenditure is represented as a capital C. So, it refers to total expenditure incurred by households on purchase of goods and services during the accounting year. So, in one accounting year or in one financial year, how much a household is doing its expenditure, how much he is doing the expenses on the goods and services. So, consumption expenditure is directly influenced by the level of disposable income. But obvious, Your income and consumption will have direct relationship. If your income increases, you will increase your consumption. If your income decreases, you will decrease your consumption. So that is why they are saying that consumption expenditure directly depends upon the disposable income. What is your income? Higher the disposable income, more is the consumption expenditure. Lower the disposable income, lower will be the consumption expenditure. So consumption expenditure is an exant concept. Now you are going to study further what is exant and ex post. As of for now, just understand exant means which is planned, okay, which is just planned. It is not the actual expenditure, it is just a planned expenditure. So we already have studied in the meaning of AD that AD will include all the planned expenditure of the four sectors of economy. So consumption expenditure is also an exant concept, which is a planned consumption expenditure. So that is your first component of AD. Let us move towards our second component of AD, that is investment expenditure, which is I, which is going to be denoted as capital letter I. Investment expenditure means the expenses done on investments, and these are majorly done by firms. So you can say the second component of AD is firms, investment expenditure. So it refers to total expenditure incurred by all the private firms on capital goods. So if you remember, when we were studying about the four sectors of economy under circular flow of income, there we had already discussed that when we talk about firms, it will be including only private firms. We don't include government firms in that. So here also the same concept it remains. Here also we are talking about the investment expenditure done by the private firms on different capital goods. Capital goods can be like machinery, land, etc. It includes addition to the stock of physical capital asset such as machinery, equipment, buildings, changes in inventory and etc. This is what your capital good means. Increasing the physical stock. Physical stock, those things which can be seen by your eyes. Okay. So, investment expenditure is considered to be autonomous expenditure. Autonomous. Now comes the term autonomous expenditure. What is autonomous expenditure? So, for making the concept easier, to understand the concept in an easy way, they have said that we are going to assume that investment expenditure are always going to remain autonomous in nature. Autonomous means nothing but constant. Throughout the time, your investment expenditure remains constant. If you are assuming it to be as 50, then throughout the time it will be 50 only. If you are assuming it to be 20, every time it is going to be 20, 20, 20. So here you have considered. Remember, we have just considered in real life, in practical life, it does not happen. But to make the concept easier, we are going to just assume that we are going to keep investment expenditure autonomous in nature. Autonomous means we are going to keep it constant. It will not fluctuate with the change in level of income. Whether your income is increasing or decreasing, your investment expenditure will always remain the same. This is what we are going to assume over here. Fine. So, next is government expenditure. All the expenses which are done by the government, that also gets included under the components of AD. So, total expenditure incurred by government on consumer goods as well as on capital goods to satisfy the common needs of the economy. So, when we talk about the government expenditure, it includes both the kind of expenditure, capital as well as consumer. Both the kinds of goods government is going to purchase. So, government incurs consumption expenditure as well as investment expenditure. Of course, government is going to do consumption expenditure, government is going to consume the goods and services. Also, it is going to do the investment expenditure in the form of constructing bridge, constructing dams, constructing railways. All of these are the expenditures of the government in the form of investment. So, government undergoes through both the kind of expenditure, that is your consumption expenditure as well as investment expenditure. So, that was your third component. Consumption expenditure is incurred to meet public needs like law, order, education, health, transport, defense, etc. So when we say that government is undergoing through consumption expenditure, it is going to be on meeting of public needs like law, order, education, health, transport. Investment expenditure will involve construction of highways, roads, power plants, etc. Level of government expenditure is determined by the policy of government, which is generally guided by social welfare. How much a government will be undergoing through an expenses will completely depend upon the policies and schemes which government have prepared. Okay, depending upon that, they will decide that how much investment expenditure I am going to do. Last is net exports. Net exports is your nothing but foreign sector, rest of the world, whatever you want, you can call it. So, net export is represented as X minus M. Okay. So, exports and imports. Basically, it involves exports and imports. Now, we know what are the concept of export and import. Export means selling of goods from home country to international country, and import means purchasing of goods from international country to domestic country. Okay. So, export indicate demand for goods produced within the domestic territory of a country by the rest of the world. Import refer to demand of residents of a country for the goods that have been produced abroad. The difference between export and import is called as net exports. So, basically when you do export minus import, you get net exports. So, the fourth component of AD will become net exports. The difference between export and import is called as net exports. So, these were your four major or important components of AD, that is your aggregate demand. Next concept about which we are going to talk is AD in two sector model. If you remember, we have studied circular flow of income in two sector model. Same way, here also we are going to study about AD in two sector model. Okay. So, what we studied till now, we studied the meaning of AD, we studied the components of AD. I also showed you that how do we represent the components of AD in a symbolical way. So, how did we do it? AD is equals to C plus I plus G plus X minus M. C stands for consumption expenditure, I stands for investment expenditure, G stands for government expenditure, and X minus M is nothing but your net exports. That is the difference between export and import. Now the topic is we have to study AD in a two sector model. Now in this, what are the two sectors which we are going to consider? So let us see. The two sectors which we will be considering over here is C plus I. We are not going to include government expenditure. We are not going to include net exports. We are going to just talk about C plus I, that is consumption expenditure and investment expenditure. For your syllabus, as of for now, you just have to deal with AD in two sector model. Okay, so here we are going to study AD is equals to C plus I. That means AD in two sector model will include consumption expenditure and investment expenditure. We are going to ignore government expenditure and net exports. Okay, those two things. These two things are not going to be included in AD in two sector model. So, let me be very clear with one thing. If in exams it is asked to mention the components of AD, then in that case you are supposed to write all the four components, that is C plus I plus G plus X minus M. But if they are asking you to explain AD under two sector model, then you will be explaining only AD is equals to C plus I. So here let us begin with AD in two sector model, that is AD is equals to C plus I. The determination of income and employment is to be studied in the context of two sector model, that is households and firms. C is nothing but your households, consumption expenditure. I is nothing but your firms who are going to do the investment expenditure. So, AD, when we determine employment and income, we are going to do it with the help of two sector model, that is C and I. So even though AD has 4 components, we will be assuming AD is a function of only consumption expenditure and investment expenditure. We know that components of AD are 4. There are 4 components of AD. But when we study AD in 2-sector model, we will be considering only 2 sectors, that is C and I. AD depends upon the level of income in the economy. Yes, you will demand when you have money, you have income. So if you have more income, you will demand more. Y here stands for income, D here stands for demand. But when your income decreases, your demand will also decrease. So I can say that my AD completely depends upon the income. Definitely. So there exists a positive relation between income and level of aggregate expenditure in the economy. That is, as income rises, AD also rises, and vice versa. That means when income decreases, AD will also decrease. So in this particular flow chart, you can very clearly see that there is a direct relationship between AD and income. When two variables move into the same direction, we say that they have direct relationship within them. When your income increases, your consumption will increase. But when your income decreases, your consumption will also decrease. Now, this we will understand with the help of a very easy schedule. Let us see. You know what is AD? AD is equals to C plus I. So, when you want to draw the schedule of AD in 2-sector model, what all columns do you have to prepare? You have to prepare one is income. Then you have to prepare C, consumption. You have to prepare I, investment. And then you have to prepare AD, that is C plus I. This is how you should remember that what are the columns I need to prepare in the schedule of AD. Income is going to be there always. So, you always have to prepare the column of income, that is Y. AD, write the formula, AD is equals to C plus I. Then you know that you have to prepare the column of C, I and AD, that is equals to C plus I. So, let us begin with it. Y. Income is 0, 100, 200, 300, 400, 500 and 600. So, here very easily you can see that in every unit the income is increasing. Okay. Then comes consumption. You can see consumption is 40 units. Now, here there come a trickier or a challenging part. With 0 level of income, how can be there 40 rupees of consumption? If you don't have income, how can you consume? So yes, definitely for a person to survive in the world, to survive in the economy, will have to consume. So yes, even if there is a 0 level of income, a person is going to consume through different modes. Now what are those modes? So those mode can be borrowings, it can be savings, it can be sell of asset. So there are 3 different modes using which a person who is getting 0 level of income can consume goods and services. And very important, such type of consumptions are called as autonomous consumptions. Autonomous consumption, which is symbolically represented as small c bar. Okay, this is a very important concept. Here you can see that with 0 level of income, there is 40 units of consumption. Now, there is a question that how can a person consume for 40 rupees even if his income is 0? So, here it is a very basic logic that every person has to survive, and to survive, they will have to consume something or the other. Now, there are 3 modes using which a person can consume. First is with the help of borrowings, second is with the help of savings, and third is by selling of assets. Okay, and this kind of consumption is called as autonomous consumption. It is represented as small letter c bar. So, you can see with increase in income, my consumption is also increasing. When my income became 100, my consumption became 120. My income increased to 200, my consumption also increased to 200. Then 300, 280, 360, 400 and 520. Here very clearly we can see that with increase in income, consumption of the consumer is also increasing. And that is what we saw right now, that there is a direct relationship between income and consumption. So yes, that has been proved over here. Next column comes is of investment, which is represented as I. Okay, investment, here we have assumed that it is an autonomous investment. Autonomous investment means a constant investment. It will not fluctuate with the change in the level of income. Whether income increases or whether income decreases, my autonomous investment will always remain constant. Practically, say this does not happen, because with increase in income, my investment will also increase. With decrease in income, my investment will also decrease. But here, to understand the concept, we have made this assumption that the investment is always going to remain autonomous. That is always going to remain constant. So, since it was constant, I have considered it to be as 20. So, 20, 20, 20, 20, 20, 20 and 20. That means even if income is increasing, my autonomous investment is constant. And last column is of AD, that is C plus I. So, you have C, you have I. 40 plus 20, 60. 120 plus 20 is 140. 200 plus 20 is 220. 280 plus 20 is 300, 360 plus 20 is 380, 400 plus 20 is 420, here it should be 420, 520 plus 20 is 540. So, you got the column of AD as well. Fine, you have got everything. Now, let us represent the schedule in a graph. So, first you will draw x-axis, y-axis. On x-axis, we are going to take income. On y-axis, we are going to take AD. So, we will prepare the curves for consumption. We will prepare the curve of investment and we will prepare the curve of AD. So, investment curve, it is very simple. It is going to be straight line, horizontal, parallel to x-axis because it is constant at every level. For consumption curve, it is going to be what? See here, consumption is starting from 40. So, even if it was 0, it started from 40. Okay, and then slowly it got increasing because my income was increasing. So, that is why you can see my consumption curve is a straight line positive curve because there is a direct relationship between my income and consumption. As and when my income was increasing, my consumption was also increasing. So, I got the consumption curve as straight line positive sloping upwards. AD is also increasing. If you noticed over here, AD is also increasing with increase in my income. So, AD also, when it was 0, my AD was 60. So, it started from here and AD is also a straight line positive curve parallel to consumption curve. You can see consumption curve and AD curve are parallel to each other. So, likewise, I got the curve of AD as well. If you all want, you all can try it and represent it over here. See here, x-axis, y-axis, origin. Okay, income I have taken as 100, 200, 300, 400 and so on. And consumption I have considered as, let me see, 40, 120, 200 and so on. Accordingly, you will represent it in this graph and join the points. You will get a consumption curve, investment curve and a AD curve. This is how you represent AD and a two-sector model. So, we saw the schedule and the diagram of AD in two-sector model. Now, there are few important points which we have to remember on the basis of that diagram. Let us see what are the points. First, AD is equals to C plus I. We always have to remember that when we talk about AD in two-sector model, we will always consider only two sectors, that is consumption and investment. Second, positive consumption even when the income level is 0. That is what we saw, that when income level was 0, the consumption was of 40 units. So that is what the specialty of this curve is, that even when your income level is 0, the consumption will be of 40 units, or a positive consumption curve you are getting. So there is always some minimum level of consumption even when the income is 0. It happens because people need certain basic goods and services to sustain themselves even if income is 0. So in order to sustain, in order to survive in an economy, consumers are going to consume some or the other kind of goods and services. I also told you what are the 3 different modes through which they will consume the goods and services. Third, slope of consumption curve. So consumption curve is upward because consumption increases with increase in income. So we already saw that the consumption curve is like this. Consumption curve will never start from the origin, or even your curve will never start from the origin or from 0, because even when the income level was 0, there was some kind of consumption happening. So that is why you always have to remember your consumption curve starts from here, and this extra space is nothing but your autonomous consumption. So if you have paid proper attention to your diagram, here also you can understand that this extra thing is nothing but your autonomous consumption, which is denoted as C bar. Okay. So that is what they are saying. Consumption curve is a upward sloping curve, positive curve, because there is a positive relationship between consumption and income. Proportionate increase in consumption is less than that of income. It happens because after reaching a particular level, people start saving a part of their income. So you can see that when there is a proportionate increase in income, proportionate means every time income was increasing by 100 rupees, but you can see that your consumption does not have that proportionate nature, because at a certain point of a time, how much a consumer will consume or how much will it spend, after coming at a particular point of time, a consumer will start saving the part of their income rather than making an expenditure. Then slope of autonomous investment curve. So this was your investment curve, autonomous investment curve. That means which was horizontal straight line parallel to x-axis, because we have considered that it's an autonomous consumption. Autonomous consumption means what? The consumption investment, autonomous investment means what? Autonomous investment will always remain constant. Okay. So that is why you get a straight line parallel to x-axis. Slope of AD curve. AD curve was something like this, which was parallel to your consumption curve. So AD curve has a positive slope, which indicates that income increases, AD or aggregate expenditure also increases. So your even AD curve is positive upward sloping curve, because whenever income increases, your aggregate expenditure or your demand for goods and services will also increase. And starting point of AD curve starts from point T as a 0 level of national income. That means if you see the graph clearly, you can see that your AD is starting from point, your AD is starting from point T, because even at 0 level of income, there is some kind of consumption made by the consumer. So this was your AD in two sector model. So till now we understood what is aggregate demand, that is AD. We also understood the components of AD as well as AD in two sector model. Now next thing to understand is what is aggregate supply. See, what we said, that there are producers who are going to produce or manufacture the goods and services, as well as there are consumers who are going to consume the goods and services. Now, under consumers, we said that there are 4 sectors of economy who are going to demand for the goods and services. Like the 4 sectors were households, then firms, government, and foreign sector or rest of the world. When we sum up the demand of these 4 sectors, we call it as, when we sum up these 4 sectors, we call it as aggregate demand, which is nothing but equal to aggregate expenditure. That means these 4 sectors of an economy are going to incur some kind of expenses on the goods and services which has been produced by the producers. So, as we talk about the 4 sectors of economy over here, here also we will be talking about all the producers in the country who are going to produce the goods and services. When we sum up their production, it is called as aggregate supply. Very simple? Yes. Then the expenses which these consumers are going to do on the goods and services produced by the producers, those expenses are nothing but income for the producers, which will be called as aggregate income. But obvious, because producers are producing goods and services, they are not going to sell it for free of cost. They are going to incur some kind of income since they are selling those goods and services on some monetary exchange or on some with the exchange of money. So, they are going to generate income, they are going to generate money. So, it will be called as aggregate income. Aggregate income is nothing but national income. Yes, aggregate income is called as nothing but national income. So, here I can say my aggregate supply is equals to national income. Okay, under aggregate demand we said AD is equals to AE, that is aggregate expenditure. Under aggregate supply, your aggregate supply becomes equal to national income. This we will prove also with the help of a schedule later on, but as of for now, you understand that why aggregate supply is called as national income. Now, let us begin with the meaning of aggregate supply. Aggregate supply, in short, you can denote it with AS, like how we denote aggregate demand as AD, same way. So, it refers to money value of final goods and services that all the producers are willing to supply in an economy in a given time period. So, aggregate supply is nothing but the total of value final goods and services. Total value of final goods and services. Here also we are going to consider final goods, no intermediate goods. So, total value of final goods and services which all the producers are willing and able to produce in the economy at a given period of time. So, AS is equals to national income, that is aggregate supply is equals to national income. Why? Because there are few sectors of an economy who are going to demand for the product. When they demand, they are going to undergo through some kind of expenses. Their expenses is income for the producers. So, basically producers are generating income which is aggregate income, and in economical term we can call it as national income. So, hence AS is equals to national income. So, when AS is expressed in physical terms, it refers to total output of goods and services in an economy. Yes, that is what aggregate supply means. Aggregate supply means the total service or goods which have been produced in the economy. So, value of total output is distributed to factors of production in the form of rent, wages, interest and profit. This we already know, we are familiar with these terms. Factor services will provide their services and in return they will be getting some kind of benefits. So, factors of productions are nothing but your land, labor, capital and entrepreneur. So, the returns what we will be giving to them is rent, wages, interest and profit. So, sum total of these factor incomes at domestic and national level is termed as national income. When these factor services or factors of production generates income, when this income is sum up, it is called as aggregate income, which is nothing but national income. So, we can say that very easily that aggregate supply is equals to national income. So, that means AS is equals to Y. Y is nothing but national income. See students, in macroeconomics, we whenever see or whenever talk about income, it is by default that we are talking about national income, because in macroeconomics, we will be not talking about individual incomes. So, whenever I say income, that means national income. So, AS is equals to Y. The major proportion of national income is spent on consumption of goods and services and the balance is saved, but obvious. Imagine yourself that when your parents give you 100 rupees, you are not going to spend it the entire 100 rupees, right? You might spend 50 rupees or 60 rupees. Remaining money, what you will do? You will save it. So this is what happens here also. When the income is for 100 rupees, it is possible that 80 rupees is spent and 20 rupees is saved. Same way, if income is 100 rupees, 50 rupees is spent on consumption purpose and 50 rupees is kept for savings. Again, 100 rupees is there, 20 rupees you have spent, remaining 80 rupees is going for savings. So, it is assumed or it is said that in national income, few proportion of money is spent for consumption purpose and remaining amount is kept as savings. So, it means income is either consumed or saved. So, it easily means that income, either you are going to consume from that income or either you are going to keep it as savings. So, that is why we say that Y is equals to AS, this we already know, that is national income is equals to aggregate supply is equals to C plus S. C plus S means income is either consumed or else it goes for savings. So, AS is equals to C plus S. If you remember the components of AD, we have said AD has 4 components, C plus I plus G plus X minus M. And if I say AD in 2 sector, then we had taken only 2 sectors, that is C plus I. And now if I talk about AS, so AS is equals to C plus S. That means certain proportion of income is going to be consumed and certain proportion of income is going to be at savings. So here you can see in this chart that consumption, which stands for capital letter C, savings, which stand for capital letter S. When you add consumption and savings, you get national income. So that is what I also gave you as an example, that if your national income is 500 rupees, out of 500 rupees, 300 rupees has been spent for consumption purpose. So remaining 200 rupees will be going into savings. This is what we say. So the components of aggregate supply is C and S. That means consumption plus savings. Okay, very important part of aggregate supply. Now we are going to see a schedule of aggregate supply. How I told you that how can you remember with which all columns you should prepare? Keep that in mind. AS is equals to C plus S. Everywhere income is mandate, you have to prepare the column of income. So that is not a question. So income you have to prepare, consumption you have to prepare, savings column you have to prepare and plus AS column you will have to prepare where you will show C plus S. Here you will also get a proof that why are we saying that Y is equals to AS. How your national income is equals to aggregate supply. Let us begin with it. As I said, income and consumption column will remain as it is throughout the chapter. Wherever you are preparing these columns, it can remain as it is. There you don't have to put any brains. So, income 0, 100, 200, 300, 400, 500 and 600. Consumption is 40, 120, 200, 280, 360, 400, 520. Two things here you have to notice. First, even at the zero level of income, your consumption is going to be 40 units because this is nothing but autonomous consumption. Okay. Autonomous consumption are those kind of consumption which will not fluctuate with the level of income. So, even if income level is 0, your consumption is going to be 40 units. Okay. Then second thing what you have to notice over here is whenever income is increasing, my consumption is also increasing. So, this is a direct relationship between income and consumption. When income increases, consumption also increases. When income decreases, consumption also decreases. Third, let us come to the savings column. Savings is what? If you want to find out savings, here you can find it out. How you will find out? So, savings is income minus consumption. That is how you can convert the formula. So, 0 minus 40 is minus 40, 100 minus 120 is minus 20, 200 minus 200 is 0, 300 minus 280 is 20, 400 minus 360 is 20, 500 minus 400 is 60, 600 minus 520 is 80. So this becomes your savings column. In savings column, you can notice that first two are in negative. Why is it in negative? Because even at the less level of income, the consumption is more. In the first unit, you can see income was 0. Still 40 units were being consumed. So if income is 0, there is no option or there is no question of doing savings, no? When income is only 0, how are you going to do savings? So, but obvious your savings will be in negative. Second one, when your income was 100 rupees, but you have done over consumption, that is for 120 units. Your income was only 100, but you consumed 120. Then again, no question of savings over here as well. So that is why your saving becomes minus 20. Third, you have spent your entire income in the consumption purpose, for the consumption purpose. Your income was 200, you spent entire 200 for consumption. So, but obvious there will be no savings and hence your savings becomes 0. After that, you can see that you have consumed less. That means when your income became 300, you have consumed only for 280 rupees. So, remaining 20 rupees went for savings. So, after that point, your saving becomes positive. Again, when your income was 400, you have spent only 360 for consumption purpose. So, again, remaining amount goes for savings. Okay. Now, last column of AS, that is C plus S. C plus S means you have to add the consumption and saving column. So, 40 minus 40 is 0. So, if you know how to do it, 40 plus minus 40, plus minus is minus. So, 40 minus 40 becomes 0. 120 minus 20 becomes 100. 200 minus 0 is 200. 280 minus 20 is 300 and likewise. Okay, so you get the AS column. Now you have to notice one thing. Just check the income column and the AS column. What similarity can you see? So, the similarity what we can see over here is exact values. Here it is 0, here is also 0. Here it is 100, here also it becomes 100. Here it is 200, here also it becomes 200 and the same pattern goes on. So, with this schedule, very easily you can prove that yes, national income is equals to aggregate supply. That is Y is equals to AS. Very nicely we have proven this over here. Now, let us move towards the diagram. Diagram is very simple for aggregate supply. You just have to draw a 45-degree line in the graph. So, this is x-axis, this is y-axis. On x-axis, we have taken income. On y-axis, we will be taking consumption and saving, or we will be taking, you can say, AS. Then 100, 200, 300 was the income. Here, if you want, you can take the number like that. So, if you see over here, 100, 0, 200, 300, 400, 500 and 600. So, when you represent the line, you get this 45-degree angle that becomes your income or AS. Okay, very simple diagram for aggregate supply. You just have to draw the 45-degree straight line and it is mandate to show this 45-degree angle. If you don't show that, your marks will get deducted for sure. So, it is compulsory to represent or show that angle of 45 degree. Very simple diagram, you don't have to do anything. Income you have computed on x-axis, AS you will be computing on y-axis, and when you jot down the points of income and AS, you will get a 45-degree straight line. That is your income or AS line. Now, here there is a small diagram explanation that in figure, income is represented on x-axis, consumption and saving are measured on y-axis. 45-degree line which represents aggregate supply has been drawn. Okay, so the line is drawn by taking the same scale on both the axes. At every point on this 45-degree line, that is y is equals to C plus S. 45-degree line, yes, definitely correct. You have to take a 45-degree line. X-axis and y-axis have the same scale of 100, 100, 100, 100, 200, 300, 400, same way 100, 200, 300, 400. So, same scale and hence you get a straight line 45-degree angle. So, supply is obtained by adding consumption and saving. We know that how you will get AS, by adding consumption and savings. That is, AS is equals to C plus S. When you do so, you will get a 45-degree angle by establishing Y is equals to C plus S. So, Y or AS can be used interchangeably. They means C plus S. Okay, then they are saying that 45-degree line consumption is equal to income. It helps under Keynesian economic analysis since two variable consumption and aggregate expenditure and income are measured in the same units. You can see there were same units 100, 200, 300, 400, 100, 200, 300 and 400. So now we know what is AS, AD, everything. Next important thing is about consumption function. Till now we know what is consumption, right? Consuming of goods and services. When you consume goods and services, you are not going to consume it for free of cost. Of course, you are going to pay some money. You are going to pay some value for consuming the goods and services. And that is nothing but expenditure. So, consumption expenditure. Now, what is this function? What is this consumption function talks about? So, consumption function refers to the portion of income which is spent on the purchase of goods and services at the given level of income. So, consumption function is nothing but the portion of income which is spent on the purchase of goods and services. For example, your income is 100 rupees and out of this 100 rupees you have consumed for 60 rupees. So, this is nothing but your consumption function, that out of 100 rupees you have spent 60 rupees to consume the goods and services. So, consumption function is nothing but, very important, functional relationship between consumption and national income. That is, consumption function is the relationship between, not just the relationship, but functional relationship between consumption and national income. Symbolically or with equation, you can represent it as C is equals to F of Y, where C stands for consumption, Y stands for national income, and F stands for consumption functional relationship. So, F stands for functional relationship. So, consumption function is nothing but the functional relationship between consumption and income. So, we represent it as C is equals to F of Y. Consumption function represents the willingness of households to purchase goods and services at the given level of income during a given period of time. So, consumption function basically will talk about the willingness of the consumer, willingness of the household to spend the certain proportion of their income in order to consume goods and services. For example, 500 is the income and consumer is willing to spend 300 for consumption purpose. So, this is nothing but consumption function. It shows consumption level at different level in an economy, income in the economy. So, with different level of income, consumption function will also keep on changing. So, we can say that consumption function completely depends upon the income of the person. So, psychological concept as it influenced by subject factors like consumer preferences, habits, taste, fashion, etc. So, see, we say that consumption function is a psychological concept. Again, very important, such kind of statements can be asked for your assertion reasoning question or multiple choice question. So, we say consumption function as a psychological concept. Why? Because it is related to the mindset of the human beings, to the subjective factors of the human beings, like what are the consumer preferences, habits, taste, fashion. Depending upon that, their consumption will keep on changing. So, it's a psychological concept. Now, we will understand consumption function with the help of a schedule. So, schedule says income and consumption. Income is 0, 100, 200, 300, 400, 500 and 600. Consumption represented by the capital letter C. Consumption, you can see directly that it is related with the level of income. With increase in income, consumption is also increasing continuously. So, you can see when the income level was 0, still consumption was 40 units. Okay, when even if the consumption was 40. Why? because of autonomous consumption. This concept is called as autonomous consumption. That means the person is going to consume even if his income level is 0. Then thereafter you can see that as and when income was increasing, consumption of the person was also increasing. Like when income got 100, consumption was 120. Income again got increased to 200, consumption got increased to 200. Income again got increased to 300, consumption also got increased to 280. That means you can directly see that as and when income was increasing, consumption is also increasing. So there is a direct relationship between income and consumption. So it is very simple to draw the diagram. On x-axis we are taking income, on y-axis we have taken consumption. See students, here we have not represented points on x-axis and y-axis. You are supposed to write down the scale while you are computing the diagram. So x-axis, y-axis, consumption curve. Consumption curve will always start from this point. Why? Because even at the 0 level of income, my consumption was 40, and this kind of consumption is called as autonomous consumption. So this becomes my consumption curve. And income curve, income is nothing but AS. Right now we saw income is equals to aggregate supply. So income is equals to AS. So your income curve is always a straight line, positive sloping upward 45-degree angle. So the point where consumption curve and income curve meet each other is the point of break-even point. Break-even point is when the consumption is equal to income. So if you want to see the schedule, you can see this is the point where income is equals to consumption. That means income of the person was 200 and the person has spent entire 200. Okay. So he has consumed entire 200. Here I am saying person, but it is not person. We are talking about the entire economy. This is not micro, this is macro. So entire income was spent for the consumption purpose, and that is the point where consumption curve is meeting the income curve. Another thing which you have to notice over here is the concept of saving and dissaving. You can see that here the consumption curve is upwards and income curve is downwards. So that means consumption is more than income. When consumption is more than income, there is no chance of saving, right? It's a logical thing. When you are consuming more than your income level, then how come you are going to do the savings? And that is why this proportion will be called as dis-savings. On the other hand, after the break-even point, you can see that income curve is upwards, consumption curve is downwards. So that means income is more than consumption. When your income is more than consumption, at that point of time, you can do savings. That means if your income is 500 and you have consumed just 300, then remaining 200 you can put it as savings. On the other hand, in first situation, if your income is 500 and entirely you are using your income, then in that case there will be no savings, zero savings. So that is why the point before the break-even point is the part of dis-saving. After break-even point, people are going to start saving the money. You can here also you can see that in the starting part, you can see that there was no savings, right? In the first part, you can see no savings, zero savings, because income is not there. So consumption will be but obvious less. 100, 120, that means income was 100, but consumption was 120. Again, no chance of savings. 200 equals to 200. That means the entire income has been spent on consumption purpose. So you here in this diagram, it is very important to make or write this savings and dis-saving part. Dis-saving is here, and after break-even point, it becomes savings. Remember this concept, you will easily understand savings and dis-savings. Now, there are few important points related to the graph or the schedule. Let us see that. First is the point of consumption curve. Your consumption curve, if say suppose this is your x-axis, y-axis 0. Consumption curve always starts from somewhere here. Why? Because this is the part of autonomous consumption. So consumption curve will not start from the origin even if the income level is 0. So it starts from the point C on the y-axis. This states that there is autonomous consumption, which means that there is consumption even at the 0 level of income. So even if the income, this is income, here we are going to represent income. So let us just make it Y. So here it is income and here it is consumption. So even when here you can see in the schedule that the income is 0, consumption is 40. So even at 0 level of income, the consumption is 40. And why so? Because of autonomous consumption. So that is why your consumption curve will never start from the origin even if the income is 0. Next is the slope. So slope of consumption curve is positive sloping as income and consumption has direct relationship. I already said income and consumption has direct relationship. That means when income increases, consumption increases. When income decreases, consumption will decrease. So there is a direct relationship between income and consumption, and that is why the consumption curve which you get will always be positive upward sloping curve. Next, when I is less than C, that means when income is less than consumption, you can write it as I, you can write it as Y, whatever is comfortable. When income is less than consumption, what happens? So there exists dis-saving. That means household are using their savings or borrowing money or they are selling their assets. That is why it is possible that income is more than consumption. So say suppose your income is 100 but you are spending 120. So here what will happen? But obvious, this will be the part of savings because you just have 100 rupees. With that 100 rupees, as it is, you are overspending. 120 is overspending. So you don't have any remaining amount to do the savings. So this is one point. Next is break-even point when consumption is equals to income. That means if your income is 100 rupees, you are consuming entire amount of your income, that is 100 rupees. So this is when your C is equals to Y, and when this happens, your consumption curve and income curve will intersect each other at one point, and that point will be called as break-even point. That is BEP. Next, income is more than consumption. What will happen when your income is more than consumption? There will be the part of savings. That means now you can do savings. For example, income is 100 rupees and you are spending just 50 rupees. So you still have 50 rupees. So this 50 rupees will be the part of savings. So when income is more than consumption, it depicts excess of income which leads to ultimately savings. Next is types of consumption function, which we also called as propensity to consume. Propensity to consume means nothing but tendency to consume. That means when a consumer is consuming, what is his tendency? What is his propensity? How is he consuming? How much proportion of income is he going to spend on consumption purpose? So this is what is called as propensity to consume or tendency to consume, which is nothing but types of consumption function. So two technical aspects of propensity to consume. Propensity here means nothing but tendency. That means the nature, the behavior of a consumer to consume goods and services. So basically it is of two types, that is average propensity to consume, that is APC, and MPC, that is marginal propensity to consume. Average propensity to consume and marginal propensity to consume. Two types of propensity to consume of a consumption function. First, let us understand what is APC. Then we will go towards MPC. APC is average propensity to consume. That means what is the average tendency of the consumer to consume goods and services from the given level of income. So average propensity to consume refers to ratio of consumption expenditure to the corresponding level of income. That means how much proportion of the income consumer is going to consume for the goods and services, or how much proportion of income he is going to spend on the consumption of goods and services. This is nothing but average propensity to consume. It has an equation. APC is equals to C upon Y. C stands for consumption, Y stands for income. APC is average propensity to consume. That means how much level of income a consumer is going to spend on the consumption purpose. So, for example, I say that income is 100 rupees and consumption is 50 rupees. So, tell me what will be the APC? So, APC is C upon Y. So, C is 50 upon 100. So, likewise, half, that means 0.5 proportion of the income will be used by the consumer for consumption expenditure or for consumption purpose. This is how you calculate APC. In exam, there is a possibility of a numerical questions for 2 marks or 1 marks or for MCQs as well at times. So, APC example, one more example they have taken over here. If consumption expenditure is 70 crores, that means if C is 70, national income is 100 crores, that means Y is 100. Then what will be the APC? So, APC is equals to C upon Y. C is 70 upon Y is 100. You know now what is it? 0.70. If I want to convert it into the percentage, it becomes 70%. So that means a consumer will be spending 70% of his income on consumption expenditure. And in the previous example, we were getting answer as 0.5. If I convert it into percentage, it becomes 50%. So there we will say that consumer is spending 50% of his income on consumption expenditure. Now again for this we have a schedule, very simple schedule: income, consumption and APC. Okay, so APC is nothing but C by Y. Again, likewise, we will understand that what all columns we need to prepare. So, we will need C column, we will need Y column and we will need APC column. So, Y and C, from the starting, whatever we are writing the values, you can take the same values. Do not change it. So, 0, 100, 200, 300, 400, 40, 120, 200, 280, 360. You don't have to make big long table. Just 5 units are fine. And APC is nothing but C upon Y. So, for first one, C upon Y, 40 upon 0 is indefinite. So, nothing we will write. Next, 120 upon 100 becomes 1.20. Next, 200 upon 200 is 1. Then, 280 upon 300 becomes 0.9. And last, 360 upon 400 becomes 0.90. So, you can see the value of APC is decreasing. First, it was 1.20, it became 1, then it went to 0.933, then 0.9. So, you can see that with increase in the level of income, the value of APC, that is average propensity to consume, is decreasing. So, there is an inverse relationship between income and APC. Now, represent it on a graph. Okay, this is the graph. On x-axis we have taken income, y-axis we have taken consumption. So, we know consumption curve is what? This is what the consumption curve is. It is always going to start from here. Okay, even if the level of income is 0, your consumption curve will start from 40, 60, 20, whatever you are assuming from there. And if you join these curves, you get nothing but your APC curve. So, here this part and this part is assumed to be equal. Okay, so I can say NA is equals to OY1. Same way, this part and this part is assumed to be equal. So, NO is equals to AY1. So, APC I know is equals to C by Y. So, C you can take, how you will take C? C can be taken as ON. Okay, this is ON. So, ON upon Y, how will you be taking Y? This is the Y. So, OY1. So, if you want to represent the diagram in the formula, then you can write ON upon OY1. So, very simple curve of APC. Now, again, there are few important points of APC related to APC. First is APC is more than 1. Average propensity to consume is more than 1. So as long as consumption is more than national income, before the break-even point, APC will always be more than 1. So you can see it here in the table that here APC was more than 1, that is 1.20. Why? Because the person was consuming more than his income. So again, you take another example that income is 200, but he is consuming 220. So what will happen? 220 upon 200. When you take out the value, again you will get the value as more than 1. Whatever the answer comes will be more than 1. Why? Because the consumer is consuming more than his income. Next, EPC is equals to 1. APC will be equal to 1 when consumer is consuming equal to his consumption, equal to his income. So, APC will be equal to 1 when the consumer is consuming his entire income. For example, say suppose we know APC is C by Y. Say suppose the income of consumer is 200, consumption is also 200. So, C upon Y, C is 200, Y is also 200, you got 1. So, here very clearly you can see that APC is equals to 1. APC will be equal to 1 when the consumer is spending his entire income for the consumption purpose. APC is less than 1. Now, the value of APC will be less than 1 after break-even point when consumption is reduced, when consumption will be less than the national income. When consumer consume less than the national income, its APC become less than 1. For example, income is 100 but consumption is 50. So, you know APC is equals to C by Y. C is 50 upon Y is 100. So, that becomes 0.5. So, 0.5 is less than 1. Why it is 0.5? Because consumer has consumed less than its national income. When consumer consume less than its national income, your APC value will always be less than 1. Very important concepts. These are asked in a factual type questions, and as well as when you write the answer, you have to be very specific with these points. Next, APC falls with increase in income. So, we already saw that average propensity to consume, that is APC, is falling with increase in income. I already said it over here that with increase in income, APC is falling, that is average propensity to consume is falling. Now, why this happens? Because the proportion of income spent on consumption keeps on decreasing. See, not every time your income is increasing and every time you are increasing the consumption. After coming at a particular point of time, you will reduce your consumption will start reducing. So, that is the reason why APC falls with increase in income. APC can never be 0 only when consumption becomes 0. So, APC can never be 0. Is it possible that the consumer is not spending any amount of money on consumption? For example, income is 100 and consumption is 0. No consumption, even if your income level is 100. So, what will happen? APC is equals to C upon Y. C is 0 upon 100. APC is 0 or indefinite. This is not possible ever. So, your APC can never be 0 because we have already studied that even if the level of income is 0, our consumption cannot be 0. Then if your income is 100, then how come your consumption will be 0? So, that is why APC can never be 0. Next type of consumption function is MPC, that is marginal propensity to consume. Always remember, whenever we study economics, in economics, marginal will always mean additional or addition. Okay, always fit it into your mind. Marginal means additional. So, marginal propensity to consume or MPC says that what if there is increment in income, there is additional income for the consumer. How much proportion of that additional income will be spent by the consumer? That is nothing but marginal propensity to consume. That means if the consumer's income increases, then how much proportion of that increased income will be spent by the consumer. This is the concept of MPC. So MPC refers to ratio of change in consumption expenditure to change in total income. That means when income changes, how much consumption expenditure will change. So MPC explains what proportion of change in income is spent on consumption. So the formula for MPC is change in consumption upon change in income. Delta, this triangle is called as delta. It depicts the change. Basically, this sign shows the change in income and change in consumption. So that is why we use this sign. MPC is equals to change in C upon change in Y. Let us understand it with the help of example. If consumption expenditure increases from 70 to 110, so for example, your C and Y. C was 70, now your consumption has increased to 110. Why it has increased? Because there was increase in income from 100 to 200. That means earlier your income was 100, now your income is 200. So when the income was 100, we used to spend 70 rupees. Now there is additional income, incremental income, that is 200. Then out of 200, the consumer is spending 110 rupees. Now you have to find out the value of MPC. So MPC is equals to change in consumption upon change in Y. So change in consumption is 110 minus 70 upon change in Y can be 200 minus 100. So 170 minus 110 minus 70 becomes 40 upon 200 minus 100 becomes 100. When you calculate this, you get the answer as 0.4. That means 40% of the incremental income is spent on consumption expenditure by the consumer. Again, we will understand it with the help of an schedule. So, income, consumption, we know what is the formula of MPC, change in C upon change in Y. To find out change in C, you will first of all know what is C. To find change in Y, you should know what is Y. So, what all columns you will prepare? Y column you are going to prepare, C column you are going to prepare. Change in C you will be finding out, change in Y you will be finding out, and finally MPC we will be finding out. So, income consumption remains as it is 0, 100, 200, 300, 400. Consumption is 40, 120, 200, 280, 360. Change in consumption 40 up we don't know. So, we have kept as indefinite. 120 minus 40 is 80. 200 minus 120 is 80. 280 minus 200 is 80. 360 minus 280 is again 80. See here coincidentally you are getting change in consumption as equal. Not necessary that every time change in consumption will be equal. Okay, so don't think that it should always be equal. No. Change in Y. So first before 0 we don't know what it is. So we have kept it as it is. 100 minus 0 is 100, 200 minus 100 is 100, 300 minus 200 is 100 and 400 minus 300 is 100. So the change in Y you are getting is also 100, 100, 100 and 100. Now MPC, change in C upon change in Y. So change in C is 80 and change in Y is 100. So 80 upon 100 is 0.8. Again